Hello, I'm Alex Mozet, and welcome to Winner Take All, where we talk about the constant battle between large tech monopolies and traditional incumbents. We have a number of people on the show who say, well, what is it that you do, Alex? What is it that Applico does? And just in the past 24 hours, it was announced that Ahold Delhaize, one of the largest grocery retailers in the world, probably doing around $70 billion in revenue. In the US, they own things like Stop and Shop, Food Lion. They own grocery stores and chains in the US and in Europe, is acquiring FreshDirect. And Applico was fortunate to be able to be an advisor on this transaction and analyze the acquisition target being FreshDirect. While I can't speak specifically to the details of the transaction, I think what's really interesting and what makes this such a compelling deal for Ahold is that if you look at the broader spectrum of what's going on with food, what's going on with just digital e-commerce purchasing, obviously we've talked a lot on the show about looking at, in March, April, right when COVID hit, looking at digital grocery orders, where Instacart spiked up to be the number one player for a period of time, beating that of Walmart even. And we're clearly seeing this shift. But, the interesting thing here is if you don't know what FreshDirect does, FreshDirect is based in the New York area, and they deliver fresh groceries, huge emphasis on fresh goods, really kind of premium quality products. They deliver. There's no store that you go into for FreshDirect, right? You are buying it online in an app. That's the only way to do it. You can't go in. There is no store, right? It's direct from a warehouse to your doorstep. I think if we just look at what's going on with these large tech monopolies in marketplace businesses, whether in the US, China, Europe, obviously this is the future. Right? You're seeing this model of saying, how can I give you, next day, same day delivery of goods and at a great price? It's frictionless, right? I mean, and this, this news talked about this at different times, right? But I mean, look at this. This isn't food specific. Amazon plans to put 1,000 warehouses in suburban neighborhoods. Amazon plans to open 1,000 small delivery hubs in cities and suburbs all over the U.S. The facilities, which will eventually number about 1,500, will bring products closer to customers, making shopping online about as fast and as quick as it is to run to the store. This is the new way of shopping. COVID has been a huge accelerant. We heard Doug McMillon, CEO of Walmart. We're going to cover their earnings release in a couple topics here. But, clearly this is the way of the world. And having an asset like FreshDirect, which is really at the forefront of doing this right, straight from a warehouse to your doorstep, high quality products at good prices, to me is a big asset, right? As we just look at the way of the world when it comes to fulfilling digital orders and grocery being a huge driver, right? I mean, what was the big driver for Walmart's digital prowess that we see? It was their pickup in store capability for groceries, right? That was that kind of killer hook that Walmart did, was to say, hey, order your groceries on an app and pick it up at the store. They're going to be ready for you. You don't need to come into the store. That's really the thing that sent Walmart's app and then had reverberations for the rest of their e-commerce we're going to get to in a second. Grocery, you look at purchasing frequency, you look at the demand, it's not going anywhere. You got to do it. And this new fulfillment model, the I don't want to go into the store fulfillment model, is certainly on the rise. And I think this deal is a great testament to that. And I'm excited to see where it goes for Ahold and the folks over at FreshDirect. So that's very exciting and job well done to all those involved. Next one is Apple. Apple making a not so smart decision. Apple has now announced that they're going to cut their App Store fees in half for most developers. So it's not going to apply to the large app developers like Spotify, But for smaller developers, it's basically going to partially cut fees up to $1 million a year. There's some caps and some, ins and outs of it. But here's the thing. This is a weak move. And, I don't think Tim Cook did a good job on this. What does this do? Already the reactions from the developers aren't saying, "Oh, thank you, Apple. Apple, this is so nice of you. The big tyrant is no longer the tyrant. We now are so fond of you, Apple." No one's saying that. Here's what they're saying. The changes fail to appease one of the more vocal small developers who relies on Apple's ecosystem. These guys are rich, by the way. So, don't take too much pity on them. If you're a developer making $1 million, Apple is still asking to be paid $150,000, right? Just to process payments on the monopoly computing platform in the US. That's obscene. So basically that's saying a 15% take rate instead of 30% take rate, and then they go on, what do you want? What do you really want from Apple? Simple. We want the choice to use a different payment processor so we can have competition. Monopoly platform can't mean monopoly payments. It can, actually. Sorry. And the right to tell customers that our software is for sale without linguistic contortions. This means he wants to be able to tell you that when you download his app for free on the App Store, he wants to say, don't pay for it here, but go pay for it over there, cutting Apple out of the transaction. We call that platform leakage, which no platform in their right mind would ever allow. But for some reason, Tim Cook has caved. He is kowtowed to a relatively small, but very vocal community of developers that want to engage in platform leakage. And frankly, it's a dumb decision. It's a weak decision. And that's not what you want to project. What does this do? Does it actually lighten up any of the vitriol against Apple? No, of course it doesn't. It actually increases it. Because now what it shows, there's blood in the water. And when you give an inch, they take a mile. And now Apple's going to have even more claims against it. Because now they're showing that they're going to budge. Since the beginning of the App Store, literally, since Steve Jobs, may he rest in peace, they have been charging 30%. Okay? Why did Tim Cook decide to change this? Apple has produced all these studies. Apple published a study that claimed its 30% cut is normal for the industry or lower than some app stores. So now Apple's commissioned all this research that says we're paying, we're charging what's normal. We're not overcharging. And now, do you believe that research? Right now all it's doing is discrediting Apple's own research and Apple's own prior position. Now you say, well, I can't believe anything you're saying, Apple, because you just are making arbitrary decisions, which is exactly what they're doing. This is a horrible decision, a sign of weakness by Tim Cook, really bad leadership on his part and the rest of the leadership team in Apple. I can tell you if Steve Jobs were around today, this would not have happened. A real dumb decision, and it's only going to create more problems than solve them. So great job, Apple executives. Why do you make hundreds of millions of dollars? Because this decision does not justify it. I can tell you that much. Not to mention, you're now just blowing away billions of dollars in revenue, as the analysts here have covered, and will continue to now, hit. This is their highest margin revenue. It's literally like 95+% margin, just goes straight to their bottom line and poof, gone, because of, COVID is their excuse. But they're never going to be able to reclaim this ground, COVID. Okay. When COVID is gone and everyone's got a vaccine, you think Apple's going to be able to raise this back to 30%? No, they've shot themselves in the foot and actually gained nothing from it. So horrible decision. Okay. Next topic, Walmart. Walmart came out with their Q3 earnings, and they're on fire. Same store sales grew 6.4% in the United States. E-commerce sales grew 79%. 79%. Look at this chart. Boom. This is the money slide. This is what Walmart needs to put in their press release. I mean, look at this. 79%. Look at Q2. Almost 100%. Right? Compared to 2019 Q3, they had a 41% growth. This is year over year growth, right? So measuring what were the sales in Q3 from the prior year compared to this year's Q3. So it's year over year, not quarter over quarter. 41% year over year was the calculation from 2018 versus 2019 Q3, right? 41%. Now 2019 versus 2020 is 79%. This is how you build a dominant marketplace. Doug McMillan, Mark, the whole team over there, they understand marketplaces. They are on an absolute supply craze. They are trying to sign up third-party sellers as a top priority in the business. It makes complete sense. Their e-commerce demand is on fire, and you got to feed the beast. How do you feed the beast? You bring in more third-party sellers. You bring in more variety. You make more competitive prices, right, from more sellers competing on the same SKUs. They are absolutely crushing it. They had to jumpstart it. They were jumpstarting it with digital grocery ordering, pickup in store, grocery integration. That's a linear kind of hack that they did. But then, boom, they were ready. They'd invested. COVID hit, and this trend, as Doug and others in their press release say, this is accelerating e-commerce and digital buying trends by years, and they see it continuing. They don't see this kind of bouncing back to the old days. This is going to be a lasting impact on people's behavior, and Walmart is there to benefit, and they deserve it. They bought Jet.com in 2016. They granted it took them 22 years to make a serious transaction since Amazon was founded in 94. So they had a little bit of time. They tried to do Walmart Marketplace, build from scratch model 2009. They bought Jet 2016. They've been at it. Wasn't like, if they had done this 15 years ago, just imagine where they'd be. But anyway, nonetheless, I give absolute credit to Doug and Mark and the team over there at Walmart. They invested in this far ahead of the rest of their kind of retail peers. They took risks. They've continued to invest at least $1 billion a year into e-commerce and fulfillment capabilities that they needed to get 2-day delivery and all these kinds of things that they're doing. They are now, starting to show you can compete. The incumbent Walmart can compete against the tech monopoly, Amazon, and prove successful, right? That Walmart does have intrinsic assets. They've got stores, they've got fulfillment capability, they've got supplier relationships. That Walmart can compete and can be successful in competing with Amazon. Walmart today has a market cap of $430 billion. Amazon has a market cap of $1.56 trillion. When you actually look at the throughput, Walmart sells more stuff than Amazon. Okay. Walmart, call it a little less than a fourth the size of Amazon, sells more stuff than Amazon, is not even a third valuation size of Amazon. Okay. This is a story of saying if Walmart can show marketplace working, show digital working, e-commerce working, and you think about the multiple that Walmart can command, right? If you look at what their multiple is, they have a PE ratio of about 22, and Amazon's ratio is 91. So when you look at that, right? Actually, Amazon's 4 times as expensive as Walmart. If you look at the PE ratio, why? Well, is Amazon overvalued? You could have that argument, sure. I would say, is Walmart undervalued? And I would say, yes, full disclosure, Walmart is not in Platt. One day they will when they have enough e-commerce and GMV, but they haven't disclosed that stuff recently. We're kind of guesstimating where it's at. One day I think Walmart will be in Platt. Until that point, I do own Walmart personally and am very bullish on where they will go over the next few years. Okay, last topic. China crackdown. Is this new, or what's going on in Beijing? You could say, it's probably a good thing that Platt, the platform ETF, the we launched with Wisdom Trees ETF, Platts on fire. You could say, oh, probably a good idea that you limited that international exposure, that Chinese exposure, which was done this summer. This is why it's a good thing, because here is Tencent, Alibaba, and Meituan, the like Uber Eats and ride sharing, equivalent, Meituan, Dianping, in China. Here's their shares over the past couple weeks. Not doing so hot. Why is that? Big tech monopoly crackdown hits China. We started maybe a couple episodes, we were talking about Jack Ma mouthing off against the powers that be. Don't bite the hand that feeds you, Jack. Well, he decided to basically say the government is stupid. Surprise, the bureaucrats in China didn't really take too kindly to that, and they killed and canceled his Ant Financial IPO. Yeah, could have had better timing there. And now the crackdown continues beyond Ant. It's now going to Alibaba. It's going to the rest of the tech monopolies. Interesting thing here is that one of the things they call out is that these tech monopolies in China are actually co-conspirators. They are coordinating their efforts amongst themselves to stamp out competition. So alliances that squeeze out smaller rivals and subsidizing services at below cost to eliminate competitors. That part is normal. The alliances that squeeze out smaller rivals, I mean, that's some vindictive stuff, guys. I mean, just competing against one tech monopoly is hard enough. Now they're teaming up. Now they're teaming up to beat out other rivals. I mean, that's some next level. That's some next level antitrust, anti-competitive type of behavior. Now, the Chinese officials are trying to establish a framework to curb this anti-competitive behavior. They're going after all the big players that you would expect. They're looking at. They may also require companies that operate what they call a variable interest entity. This is a vehicle through which virtually every major Chinese internet company attracts foreign investment and lists overseas. So, right, for any of these tech monopolies that are getting outside investor capital, these companies may have to apply for specific operating approvals. So I guess this is now another mechanism to assert even more control over the tech monopolies. I guess, start to get into foreign investors' control and how much sway they have with these companies. So we had heard rumors of this. One of the things, surprise, in this Wall Street Journal article, which is all over the place, is they reference how Ant Financial is being smeared in these reports. I wonder how that happens, Jack Ma. And Ant Financial is taking advantage of consumers with lending, right? Predatory lending, providing credit cards and debt too freely to, take advantage of these upstanding, communist citizens in China. Not a good thing you want to be branded as if you got a communist country, to be a money grubber that takes advantage of its people with debt, predatory debt. That's not a good rhetoric to have applied to your company. Well, that's now Ant Financial. I would imagine this means that definitely any of these other Chinese tech monopolies are going to be way more reticent to do anything in financial services, or are really going to be scrutinizing. They do have activity in financial services, what they're going to continue to do, if anything, in financial services, because that is certainly going to be a hot button here. But in general, we've already seen the Chinese government literally staff departments of government officials inside of these tech monopolies. We've been covering that for months. And these government officials in these businesses, literally in the office, are coordinating what content, for example, should be allowed, what users should be penalized, and making sure that the conversations and communications and dialogue on particularly the social media and content platforms are up to snuff. That we've spoken about on the show also had hampered the share price of many of these tech monopoly stocks if they had a content platform play, because they were open to more regulatory scrutiny as a result of that. So, I think this is more a kind of just continuation of stuff that we've seen. I don't I think just the Ant Financial stuff really must have struck a nasty chord within the CCP, and now they are lashing out. And there's nothing you can do about it. Nothing you can do. We're seeing, for example, in the United States, we're seeing ByteDance and TikTok try to challenge, the Trump administration's executive order blocking the ban of TikTok and these kinds of things, and they have at least have a mechanism to try. Yes, there are court systems in China, but look, we all understand that when the CCP, when this comes on down from high up above, you better just pray and kiss the ring and hope that they don't get too grumpy with you, because there really is not much recourse these companies are going to be able to do, depending upon how this goes. So more to come on that. The last thing actually is, I got to do that. The last thing actually is this. I'll leave you on a fun note. So a few episodes ago, I was saying, I don't know why. I don't know why Elliott Management decided to keep Jack Dorsey as CEO of Twitter. I don't think he's done a good job. Don't think they've had, clearly they had flat growth, literally flat growth, in their latest earnings release. And, the guy was back on Capitol Hill testifying. Look at the guy. This is the CEO. This is the CEO of Twitter testifying to the Senate. It's just unprofessional. Yeah, $30 billion company. The guy is CEO of 2 companies, by the way. That's also unheard of. Apparently, he's really barely involved at Twitter. His executive team wants more time from him. They can't get it. Not to mention, the executive team underneath Jack is just not that strong. Sorry, guys. That's the word on the street. You're just not that strong. And I bet if you were stronger, Elliott Management would have probably picked one of you to be the new CEO. But they probably looked at the state of the leadership and said, I don't want any of these people to run the company. So now I'm just stuck with Jack Dorsey. And if you get rid of Jack Dorsey, probably that executive team then mutinies or leaves or something. Elliott Management is just... Elliott Management's activist just stuff they've been doing. It's not really panned out too well. I think they're exiting AT&T now, and they got very aggressive with a number of companies, and I didn't really understand the plan that they had. We've talked about that on the show, but nonetheless, Jack Dorsey is certainly nothing to write home about in terms of CEO performance. This tweet is what I'll leave you with. October 2013, Snapchat launches Stories. August 2016, Instagram copies it. February 2017, WhatsApp copies it. March 2017, Messenger copies it. Those are all Facebook entities. November 2018, YouTube copies it. Google. September 2020, LinkedIn copies it. Microsoft. November 2020, Twitter copies it. And the annotation is, wild how closely this matches each company's reputation for shipping. What that means is reputation for innovating, for shipping product, for releasing new features and product innovations. And so Alex Stapp, I think, hits it right on the head on this one. Twitter is doing nothing that impressive and just more of the same old molasses, which is why you have flat user growth. Thank you so much for joining us today on Winner Take All. I will talk to you soon.